in relation to incomes, home prices have never been higher. We have never seen an equity bubble that is this high, where it's in relation to the economy, not just the price of equities, but in relation to the economy. Never been higher. We've never seen credit spreads this narrow before. There's massive distortions all existing together. So you could make a cogent argument, wow, this is going to be a very big wipeout in the stock market and in the asset prices.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 17th through June 24th, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this returning guest, Michael Pento, an active money manager and the founder of Pento Portfolio Strategies, joins us this Thursday, June 21st, 2024. Michael, thank you for coming back on Liberty and Finance.
As you know, always a pleasure.
Our viewers and our subscribers are always delighted to have your visits here because as an active money manager, you are bearing the responsibility for shepherding the nest eggs of many households and people who are looking to you to keep them positioned out of harm's way while taking advantage of opportunities that present themselves. And you're always looking forward, not just backward. A lot of the government statistics we get, as doctored as they are tend to be backward indicators rather than forward indicators. Could you tell us what you're watching right now for the direction that the economy and our financial world is going, and what it's telling you about what we can expect perhaps in the rest of this year going ahead?
Well, it's a great question as always. So the economy is clearly slowing. It's not my prediction anymore. It's a fact. If you look at initial jobless claims, the highest 4-week moving average since September 2023, continuing claims up by 15,000. That moving average is also 4-week moving average is also the highest in quite a while. If you look at Philly Fed that came out today, if you look at retail sales, great disappointments. If you look at pending home sales, they're all not anywhere near as projected. They're all falling well short of the mark. So I don't think we're in a recession yet, but we are tending towards that direction. And on the other side of the coin, you look at, the markets. If you look at NVIDIA, it's adding the market cap of McDonald's every day. When you have a very narrow rally like this, it tends to mask what's going on underneath. For example, would it surprise you if I told you the equal weight the equal weight S&P 500 is up 4%? That includes NVIDIA. It just doesn't overweight it because of its market cap. It equals it. If you look at the Russell 2000, that's down year to date. There's 2,000 stocks there. So lots of cross currents, but the economy is clearly weakening. It's being masked by what's going on with the AI phenomenon in NVIDIA. All such narrow rallies have failed miserably in the past. You look at the Nifty 50, or if you look at the .com phenomenon. But this is really a rally that's just like one stock. So the market's very narrow. The economy's clearly weakening. If you look at things such as financial conditions and credit spreads, and that's what I would really look towards to let me and my investors know when we need to get net short in the portfolio, they're still quiescent, remarkably. But this data that's coming out just over the past month or so is really starting to lend credence to the fact that we are slowing towards a recession. I think it's inevitable that we have a recession by the end of this year.
In the past, you've also alerted us to the strain and the financial stress that the banking sector is under. Many of the banks having underwater bond portfolios or non-performing commercial loans. Can you bring us up to date on the concern that people should have about keeping their nest egg in the bank currently?
Well, nothing has healed as far as the banking system is concerned. We have had the longest inverted yield curve inversion, so the 10s minus 2s inversion in history. The longest inversion, which really brings down net interest margins for banks, because how do they make money? They have to pay their depositors, but they're collecting interest on loans. Well, if the interest they're collecting on loans is equal to or less than what they have to pay on deposits, it's a pretty hard way to make money. And if they don't want to raise their deposit rate, you have something called capital flight. People take their money out of the bank and they moved it to brokerage accounts. And you end up with a lot of money flooding into T-bills. So that's what's occurred. In fact, if you look at the reverse repo facility, something also I look assiduously at, is that has equated to the draining of that reverse repo facility, which is excess reserves from banks that was parked, laying fallow at the Fed. That has pushed, just in the last 12 months, $1.7 trillion of gambling money into Wall Street. So that money came out of the reverse repo facility, went in to buy bonds, newly issued bonds. That money is circling in the economy. And that's when you get, roaring kitty stocks going through the moon, and you have NVIDIA going up, the market cap of Berkshire Hathaway in a few days. It's insane. But that's $1.7 trillion is now, there's only about $350 billion left in that reverse repo facility. And I'm really watching the bond market, because when that liquidity runs dry, and it's not too long away now, it's very close. Talking about months, not quarters. I think we're going to have a lot of problems in the repo market, in the money markets, in the stock market, and in the bond market. Those are the things I'm looking at, Donegan. It's not time to panic yet. I'm just saying, if you're going hog wild over your skis in NVIDIA and going golfing and enjoying your life and saying, you know what, all you need to own is the number one stock in the AI phenomenon, you're in for a rude awakening. Because in my 33 years of doing this, being a licensed professional, this type of scenario has never ended well. And I look at something like the market cap of equities, total market cap of equities to GDP. It's 190 something percent right now. That's the highest reading ever, outside of like a couple of weeks immediately after COVID. So for reference, that ratio was 104% in 2007. It's almost 2 times more expensive. And in 2007, the market crashed by 50%, the S&P 500. Even though the bubble wasn't extent in equities, it was in real estate. And if you look at things like, how narrow the rally really is in the stock market. Because if you ask most people, they say we're in a recession and we're in a bear market. Because most stocks are down on the year. But if you look at NVIDIA is now worth over 10% of our entire US GDP. And if you add in Microsoft, NVIDIA, and Apple together, over 33% of US GDP, the total annual production and output of the United States, is less than those 3 companies. That's insane. The total market cap of equities to GDP should only be about 50-60%. But now we have 3 companies representing over a third. So this is a very narrow rally. We're heading into a recession. Banking system is under a lot of stress. Net interest margins, commercial real estate, auto loan defaults are spiking. Credit card loan defaults are spiking, even higher than they were prior to COVID. Rate of change is really moving higher. So and you ever ask yourself this question, well, why does Jerome Powell and the maniac people who run DC, Elizabeth Warren, people who run Wall Street, like, Barry Sternlicht, who run real estate investment trusts, why are they crying? Oh, we need more rate cuts. Oh, please, you don't get it, Mr. Powell. Please cut the interest rates. I mean, inflation has risen to a point where if you look at some of these sentiment surveys, University of Michigan, I'll point out, the U.S. consumer is on its back. They've been wiped out. The The lower 3 quintiles have been wiped out because of the inflation that's already happened. So maybe this might be news to our president, Joe Biden, but inflation isn't coming down the way he thinks about it. They think prices aren't falling. The rate of change is falling. So if inflation went from 9% to 3.3%, that's still higher than 2, right, Dunnigan? But when inflation is rising at 3.3% from a level that's already wiped out the purchasing power of the middle class, how does that help them? And Powell wants to declare victory now and start cutting rates, not because he cares about Main Street, not because he knows when he cuts interest rates, home prices will go even higher and be even more unaffordable, and oil prices and commodity prices will boom, and we'll have more inflation. I mean, that's the risk he's taking when he's cutting interest rates, especially if he does it aggressively. But he's doing it to protect banks, because that's all he really cares about. And Janet Yellen, Treasury Secretary Yellen, says, according to her, she thinks that the deficit and debt are in a good place. They're in a good place. $35 trillion in debt, 125% debt to GDP, $1 trillion in interest payments, $1.7 trillion deficits. The debt to GDP was about 60% a few decades ago. Now it's 125%, 123, 125%, around that level. And that's a good place. Dunnigan, if the debt and deficits are in a good place now, when we have prosperity and the ratio, I'm not just talking about the outstanding debt, I'm talking about the ratio is growing. So, the debt is growing faster than GDP. That's unsustainable, and she thinks we're in a good place. In good times, well, Janet, we're not in a good place. We're insolvent in good times. But when a recession comes, and I think it's coming, the data is telling me it's coming, and then unemployment rates spike, and then the automatic economic stabilizers kick in, and we have a $6 trillion deficit. I mean, who's going to buy it? Are we going to be a good place? Are we going to be in a really good place? Really, really good place then? So our leaders have gone insane, and all people care about is how good NVIDIA did today. But I mean, I don't do that. I try. My charter is to make money in good markets, bull markets, bubbles, and also to get the heck out of harm's way when I see a bear market coming that's derived from a liquidity crisis or a recession, and we are headed there. I'm not positioned for it yet, but I'm prepared to get there quickly.
Yeah, I think that another word that Yellen used recently, maybe as recently as about a week ago, was sustainable for the debt. And you look at the hockey stick of the debt by any measure, and the deficit, and you wonder, how can anyone look at that who's actually telling the truth and who's thinking about the financial survival of the people, and call that sustainable?
Yeah, I mean, that's a question that doesn't really require. I mean, it's a question that you can't answer unless you say these people are disingenuous. They're using mendacity. They're prevaricators. They're liars. They care about one thing and one thing only, is their jobs and their position, and to maintain power. And they'll do it at any cost. I mean, anybody. I'm not talking about someone who's uneducated and ignorant. A person who is the former head of the Federal Reserve, who is now the head of the Treasury, that tells you that the highest ratio of debt to GDP we've ever seen, and that's including World War II, the immediate aftermath of World War II, in good times, thinks that that's a good place and sustainable. I mean, you talk about incompetence. I mean, Joseph Goebbels is someone who comes to mind of, Baghdad Bob, who tells you, the news you think you want to hear instead of the truth. I hate to use those kind of, alliterations, but you're just not getting the truth from these people.
Well, okay, on that vein, then also the ratios that you're describing, which are absolutely telling, are even optimized to try to make things look as best as they can in an untrue way. I mean, can you talk to us briefly about even these leading indicators that you're watching?
It doesn't include unfunded liabilities, that ratio, and doesn't include the fact that GDP is artificially boosted by 10 of the last 14 years after the global financial crisis, where we had near 0% interest rates. So the GDP is exaggerated. The debt and deficits are underreported. So the ratio is actually much worse, unless you're going to tell me, well, we're going to cancel Social Security and Medicare and Medicaid. Well, go ahead, you could do that if you want to. And then the ratio doesn't look so bad. But I don't know if the GDP is going to hold up if you tell people they're not going to get their Social Security checks.
Yeah, I every year around my birthday get a printout from the Social Security Administration, and they're dancing around each year about with headlines on their page 2, such as Social Security will be there for you, and then they explain how they're going to be cutting because of the insolvency of the trust fund, that they're going to have to be cutting payouts to 70% nominal commitment, that sort of thing. And this is in dollars that are already being devalued and inflated away. So even they are saying that even with the rate of inflation, which is destroying the purchasing power of the dollar, which should make it easier and easier for them to keep their nominal commitments at paying out people, they're saying, no, we're going to have to cut our nominal payouts by 70% or to 70% starting a few years from now. And they keep dancing around that number and changing it. But it's clear that even with the cooked books, they're not going to be able to keep even the semblance of the commitment to people. So I've heard others say, Social Security was always just a tax, and it's gone, that money's gone, and anything you can get out of it is lucky, but don't count on it. Well, a lot of people are counting on it. We live in a community of others who are of retirement age, and they are counting on it to make ends meet. Any comments you have for ordinary people who are trying to make prudent decisions about their life, how to manage their financial affairs, have been all their life, and they're getting this garbage info in from the keepers of the keys, and they're trying to make life-changing, life-altering decisions based on that faulty information?
Well, I can only tell you what I'm doing. I mean, well, maybe I shouldn't, because I'm not exactly the typical consumer. But I think for wealthy individuals, there's going to be a means test of Social Security. If you're worth the X, and if you make this much, whatever the number they come up with, they'll say you don't need it and just take it away from you. That's why I told my wife, she says, why are you, I'm 60 years old. I'm going to start taking it at 62. I'll take whatever they give me, because I don't think in the next few years that they're going to allow everybody to take Social Security. They'll means test it. But even if you're just the average consumer, I would take it anyway. Again, this is not financial advice. This is just my opinion of what I would tell a friend if I knew them well. Take it, because I think that they're not going to default explicitly on the Social Security commitment. They will default through inflation. They'll just print it all away. So you'll get your nominal stipend, but it won't buy you anything. That's how I think they're going to default. I mean, they're going to default either way. They have to default. Just tax space is not there. There's not enough workers for retirees. The ratio is upside down. It's nowhere near where it was in the 30s when they started this program. So they will default through inflation. So take what you can now and invest what you can now to protect yourself from a depreciating currency vis-a-vis hard assets. Not against other flawed fiat currencies, but against hard assets.
Another thing, I just want to connect two dots that you've brought up in an unrelated sphere, but I think that we might be able to tie them together here. And that is, you mentioned NVIDIA, which is being driven by the AI, artificial intelligence mania, thinking that that's the wave of the future. Invest in the future, go for artificial intelligence, because that's going to be taking over everything in the future. And then in your last breath, what you just said was, with the economy, that is employment, when we enter into a recession and we don't need those workers anymore, one of the stated aims of AI is to replace workers with technology. So, and this originally people thought, oh, this is just going to be librarians, and then now it's going to be lawyers, and now it's going to be doctors, now it's going to be all kinds of computer programmers. Everybody going to be the knowledge economy, which has been replacing the industrial economy, et cetera, is now being moved on to the next generation, where workers are going to be largely not needed in the same extent that they were if the promises of AI play out. How can that not contribute to the demise of the middle class? And the idea is, well, gee, whenever we have more efficient ways of doing things, that helps everybody. It lifts all boats. But it seems that there's a concentration of benefits that have been strangleholded by Silicon Valley, et cetera, that are not letting the benefits of those advancements benefit everyone. Your thoughts on the future of employment in the face of this burgeoning AI economy?
Well, don't worry, it'll be fine, because you could all be replaced by artificial intelligence. We'll have digital human beings doing your job, and you'll just sit home and wait for your government check to arrive in digital currency. They'll just deposit it in your bank account, and everything will be fine. You'll just sit back and watch TMZ and reruns of Jerry Springer, and your intelligence will go down, your autonomy will go down, your privacy will be removed, and you'll be fine. What's to worry about? Doesn't that sound wonderful? Look, AI is a very disruptive technology. I'm sure it'll boost productivity in the long run, but it could be very disruptive to the labor force. They tried it, post-COVID, helicopter money. I think they'll do it. I think they'll be forced to do it again, and I think they'll also have to take complete control of your currency, because interest rates are going to have to be negative in real terms for a very, very long time, maybe even in nominal terms for a very long time. And that requires paper currency, physical currency, to disappear for them to accomplish that task. See, what's to worry about?
In the face of that prospect, many of our listeners are gravitating towards real assets that hold their value over time. That's what the definition of money is. One of its attributes is supposed to be the ability to hold value over time and be a store of value. And we've certainly gone away from that. For the last several generations, people have forgotten and become accustomed to being on this sinking ship of fiat currency, like the dollar, where you figure, oh yeah, that makes sense because that was in the old dollars back when they were worth something. And not realizing what that means about our futures, that your life savings, fruits of your labor that you've stored up, being unable to sustain you going forward. So your plans for supporting and helping your clients, for example, in navigating those waters, the waters that we're in, and preserving their purchasing power going forward.
I just want to, made me think of something. I was shopping at Publix down here in Florida yesterday. I needed a underarm deodorant, and we both looked at each other. An Old Spice deodorant, aluminum free, was like $9, and we both, my wife and I, looked at each other. When did that $9 for a deodorant, a stick of deodorant? What my plan is to do this. I'm going to follow the model that I built over decades. It's called the inflation deflation economic cycle model. And it allows me to protect and profit from recessions, bear markets, liquidity crises, depressions, which I think we could have a truncated sojourn in the near future. That's the salient risk there, because we have. Why do I say that? Because I'm a Cassandra who likes to use hyperbole. That could be. Some people might think that. Or do I see concurrent bubbles that we've never had exist. Concurrent means existing at the same time. We've never had them. We've never had a bubble in real estate, and a bubble in the equity market, and a bubble in credit like we've had, all at the same time. You think about the year 2000. It was not even really an equity bubble. It was mostly a NASDAQ bubble. And then in the aughts, 2006, 2007, we had a real estate bubble. It wasn't really an equity bubble. But now you have a bond, stock, and real estate bubble, all existing concurrently, and they're at record proportions. I mean, we've never had a home price to income ratio this high, never. Now, I understand that the home ownership construct is better than, we don't have the liar loans, we don't have 110% loan to value ratios. That's a lot better. But what we do have this time is we have 25% of all homes, single family homes, owned by investors. Even though they own the home outright or they have a very little mortgage on it, it's still a home that they don't need to live in. It's rented out. So if you have a recession and you have the unemployment rate tick up and the stock market starts to fall, they will be looking for liquidity from these homes that are falling in value, that are no longer rented because your renter stopped paying you, and you need liquidity. So the inventory, the shadow inventory, can come on the market almost to the extent that it did in the subprime crisis. And then you have the home prices that have never been higher, not just nominally speaking. I always like to look at the ratios because, look, you have to look at everything in relation to something else, GDP or incomes. Well, in relation to incomes, home prices have never been higher. We have never seen an equity bubble that is this high, where it's in relation to the economy, not just the price of equities, but in relation to the economy. Never been higher. We've never seen credit spreads this narrow before. We've never seen this amount of credit card debt, corporate debt, CLOs, private credit. So there's massive distortions all existing together. So you could make a cogent argument, wow, this is going to be a very big wipeout in the stock market and in the asset prices. And by the way, that would be healthy that's what recessions are supposed to do. They're supposed to reset. It's a cathartic cleansing, purging of all the excesses. So I actually hope that happens. It would be the best thing for this country. The question is, what does Jerome Powell and Janet Yellen do about it? I'm afraid they might go back to ZIRP, and they might go back to QE. They might go back to helicopter money. But if they do so, this is the first time they're going to be doing it when the nation is starting off as an insolvent state. We've never had debt to GDP this high. We've never had $1 trillion deficits before. And they'll be doing that QE and ZIRP, doing that action to reliquify the money markets, when inflation is way above their target and has already wiped out the middle class. So, I mean, am I sure? Are you sure that when the Fed announces we've gone back to ZIRP and we've launched a QE and helicopter money is coming from the Treasury, are you sure long-term rates go down? I don't think so. I am not sure. Long duration bonds could actually go up in yield, down in price. And if that's the case, then what you're doing isn't going to save the housing market, right? It's not going to save much of anything. It's going to exacerbate the condition. So in other words, I'm trying to say there's not an easy out this time, like there was every other time since 1987.
Michael, for people who want to take advantage of your services as an active money manager, where should they get connected?
So the website is pentoport.com. I have something called the midweek reality check. It's $50 a year. There's a 5-week free trial if you want to get the news that you don't really see reported that much in mainstream financial media and my interpretation of it. I'll give you some insights to my model too. And if you have $100,000 to invest and you are a U.S. citizen, I will invest the money for you in the IDEX strategy.
And folks, if you don't want to miss a single episode with Michael on Liberty and Finance, make sure you just drop by libertyandfinance.com, put in your email address, click submit, and then make sure you confirm on the confirming email. You'll get every once per day email in your inbox with our latest guests, including all of Michael's interviews and our weekly specials. Michael, as always, on behalf of all of our viewers, thank you for joining us on Liberty and Finance.
Blessings to you, Don. Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 17th through June 24th, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.